Now, if you're looking to figure out how passive income is taxed with real estate, but you want to also know how to do it better, in fact, even show less income, even get tax returns as a result of real estate, hang in until the end. I'm going to share with you one of the big ways that some of our clients have saved massive money off their own income taxes from their jobs. So be sure to hang in until the end. All right, let's just start it out with the basic facts, right? How is real estate income taxed? It is taxed differently than normal ordinary income. The worst tax bracket you could ever be in is your ordinary income tax, the money that you earn from your job. That is the highest tax rate you could possibly be. This is why everybody hates the wealthy people, right? This is why we hate the Mitt Romneys of the world that say that, like, oh, you 47% and all that kind of crap, right? You know, we hate the rich people because they've figured out those loopholes. They know how to create businesses that give them lots of write-offs. This is why you hear people say that Warren Buffett's assistant pays more taxes than Warren Buffett, right? Well, investors and business owners get the best tax breaks, especially if you have real estate and or a business. If you have both, by the way, oh my goodness, like you have some amazing going on. But let's just talk about real estate and how it's taxed. Now, this video is recorded in 2024. If you're watching this in 2025 or some other year, this could be very different. Some of these percentages could be irrelevant to you, but basically the principle is the same. All right, so when it comes to the passive income you receive from real estate, now passive income is like your net income. After expenses are paid and everything else, the profits that you get is taxed anywhere from 10% to 37%, much like your income tax. But remember, it's a little bit more like business income because you write off things first. For example, if I have a property manager, I'm writing off those fees, right? I'm writing off the things like my mortgage payment and interest and things like that. I'm writing off any repairs I might have to do or anything else that might be involved. Any other expenses that are involved in trying to rent out that property, I'm writing that off first, and then on the net profits, that's what I pay second. Now, if you sell a property, you might pay anywhere from 0 to 20%. So on the sale of the property, it's actually cheaper than a lot of the kind of investments or even just normal income that you might get. This is why a 401k, we kind of laugh at it a little bit because when you cash money out of a 401k, no matter where it's invested, you get taxed at that highest income tax, ordinary income tax rate, because you never were taxed on it up front. You get taxed on it later. And just so you're aware, 10 to 37% even on the income tax and 20%, even if it's 20% on selling the property, is not bad. If also you could be paying 37% or more if taxes go up. By the way, I actually predict taxes will probably go up in the future. I don't know about you, but I don't really trust Uncle Sam and the rest of the government to really look out for me, right? As someone who's in like the upper middle class, you know, and that kind of thing. So be aware that you do not want to gamble hoping that politicians will give you a tax break later on. It may not happen ever. But with real estate, on the sale, it's 0 to 20%, and on the income, it's 10 to 37% of the net income. Now, one thing that a lot of people don't realize is with real estate, you can actually depreciate the property. What does that mean? Now, most people believe that real estate always goes up in value, right? Which it typically does. But did you know it's not actually the property that goes up, like meaning the structure, the house itself, but it's the land that increases in value, not the structure. Because let's be honest, as time goes on, does that structure get more expensive? Maybe, depending on what it costs to build it. But for the most part, it declines in value, just like a car, right? Maybe the cost to build a car can go up, but remember, the cars go down in value because the older they get, the more wear and tear, the less it's worth. Same thing with a house. So you're allowed to, legally, to depreciate the house over like 27 years. Now, as you depreciate that property, guess what? That offsets the net income. So after you've already paid for property management fees and mortgage interest and other things, that even deal with the lease or with repairs or whatever it might be, well now, even though you have income coming in that you actually cashed in, they're allowing you to take some depreciation on that property, meaning that they're taking like 1/27th of that property's value and writing it off on your income. This way, it's actually possible for you to pay little to no tax on a real estate property. This is one thing I've taught my clients because sometimes they'll say, yeah, but right now the cash flow isn't great on these properties. I could go and lend my money. And I said, you could lend your money and there's great options there. But if you have a 10% return on your money, but you have 30% taxes, you only get 7%. But what if you have a real estate property that your cash on cash return, your net profit is like 6 or 7%, you're making almost the same income because you might be able to write off all of that income because of depreciation. So the nice thing is you can actually still keep more of your money than you would even doing a higher paying investment. Now, many people will say, critics will say, yeah, but then when you try to sell the property, you might owe more on taxes on the back end. That's true, but if you have a good CPA and you have the right relationships in place, you can actually do tax-free transfers. I'm going to talk about here at the end. That's pretty cool. All right, and that brings me to my next point, a CPA. right? You got to have a good CPA that actually specializes in real estate investing. The problem I see today is that you get a lot of accountants out there that they can pump out a return no problem if you work a job. Some of them even do a decent job if you're a business owner. But when it comes to real estate or other kinds of investments, they have no clue. They don't know where they can draw the line or what things are actually possible. I always recommend you find a CPA that, one, is proactive, that they actually teach you the strategies. They don't just say, hey, it's the end of the year, here's your tax bill, right? We want somebody actually is proactive so that you know how you can take advantage of these tax breaks up front and then be able to apply that year after year so you can keep saving on your taxes. Now, also, I would add this too. If you're gonna have a CPA, make sure that they do know their stuff, make sure they come highly recommended. I know with our clients, that's the number one question we get lately has been, hey, do you have CPAs you can refer me to that know how to do this stuff? And the answer is yes, we do. We've had to hunt and search for them because even if you find a good CPA, once they get popular, they're too busy and then they never email you back and then you get mad because they're not emailing you back and you know how the list goes on and on. Lots of great CPAs that know how to do this, but they're in such high demand, sometimes they don't know how to grow with that growth of more clientele. So we try to find the ones that are lesser known, they still do great work, maybe even just as good if not better than the big guys you might pay $10,000 to $50,000 a year for, but they may only charge $3,000 to $6,000 a year on that front. And again, because they can save you thousands of thousands a year in taxes, you don't care about having to pay them $3,000 to $6,000 a year because you know you're going to make that money back. So there are some great CPAs, but you got to make sure you find the right ones. They're not going to be your ordinary average CPA or accountant. It's going to be somebody who specializes and understands the real estate rules. All right, the next key tip here, if you want to make sure you save on taxes, not just save on taxes, but even protect yourself legally too, is to have the right corporate structure. Many people ask, should I have an S Corp or an LLC or a C Corp, or what does this go in, or should I have any corporation at all? And the answer is most likely, if you talk to an attorney, and I would recommend talking to an attorney, the answer would be yes. You want to have these most likely in an LLC. LLCs are best for holding assets. S Corps, C Corps, not so much, but LLCs are great to be able to hold your assets. Now, how many properties you can put into one LLC, whether it's one or several, that's always up to interpretation. I would just say, again, consult an attorney. And yes, even for our clients, we even have attorneys that we have them talk to. For example, my attorneys say, Chris, with your properties, you could probably hold a couple properties in the same LLC. I say, great, I'll do that. Now, why would I hold it in an LLC? Well, one, I get more tax advantages because I have a business. Business have the best tax advantages. You can write off more things. But it's not just that. It's because, despite still doing depreciation and everything else, also, if I ever get sued, say one of those tenants want to sue me, they don't sue me personally, they have to sue the LLC. And here's the great thing about an LLC. When they sue an LLC, the only way they can get to that money, like garnish the wages from the LLC, is if we make them a partner. And guess what? Who in their right mind would ever make somebody who sues you a partner? Said no one ever, right? And so they're not going to be made a partner. So they're going to have to hope and pray they get whatever sale they might get, whether it be from the properties or whatnot. But the great thing is they have to only sue the LLC. It's only whatever's in the LLC. So if I have other LLC with other properties, they have no claim to those, even if they have equity. And even better, my own personal assets, my own personal savings and money, they can't touch it, right? Just like Hammer says, you can't touch this. And you can't touch my money either. So it's a great way to create that separation, that distance from people that might want to sue you, especially in the United States, they're really big on that, and from your money. So your wealth can keep growing regardless. So besides just tax benefits, it's great for protecting and growing your assets too. Now, let's talk about some cool real estate strategies you can do. I mentioned one was a 1031 exchange. What that means is you can do a tax-free exchange from one property to the next. Now they'll give you 45 days. When you sell a property, from the day that it sells, you have 45 days to pick another property, then another 4.5 months to then close on that property. So you have a total of 6 months to go from one property, put that equity to the next. Even if you were to get taxed a lot, anywhere from that 0 to 20%, even if you say it was the 20%, even if you could pay taxes on that, guess what? You can actually transfer the equity to another property and pay nothing. 0 in taxes. So not only are you getting this tax advantaged income where you might pay little to nothing in taxes on the income, now you're selling and upgrading to more properties, buying more properties, and you pay nothing in that process. It's kind of like if you're playing Monopoly. Remember we had those little greenhouses and the red hotels? It's like when you sell off those little greenhouses to buy a new hotel. It's the same thing. You get the equity out of those houses, then put a down payment on another property, you transfer it over, and again, no taxes on that money at all in that exchange. So that's a tax-free exchange that you can do all the way till you're dead. So that means you could pay taxes potentially never on that money, and then even pass it on to your kids, and then they can now get it from that point of wherever it was. So say you built it up to a $10 million real estate portfolio, even though you would have been taxed on 9.5 million of that, now that you're dead, now they inherit the money and they're like, oh, cool, I got now $10 million of real estate. And if I were to sell it all today, I would pay nothing, right? That's the kind of cool thing. Now, granted, laws could change. This could be obsolete in what I'm saying here, but as of right now, and especially because, let's admit it, politicians want to vote rules that help them too. They also own real estate. They want to make sure that they can pass on their money tax-free. And here's the great strategy you can do as well. If you want to get a tax write-off, not just get your taxes down to zero, but what if you can actually write off your own income from your job or your business? What if you can actually show very little income? That's where you can become a real estate professional. Now, a real estate professional, there's a lot of different rules and sometimes there's some gray area. For the most part, what I've heard as a consensus is that if you don't work another job, you can work up to, at least 750 hours a year. That's like 15 hours a week average. If you work at least 750 hours a year that are real estate based in some way, shape, or form, you can actually show a business loss from your real estate. Now, some people say, how do I do that? Well, there's a variety of ways. But besides searching for properties, what if you went and did a summer trip, you actually decided to travel, all that drive time to travel in an RV or whatever you wanted to do, to go visit these different places, take a few flyers, look at a few properties. You didn't have to buy any of them, but maybe you're looking at real estate to kind of test out, hey, where do I want to be? Or maybe I want to visit one of my properties that I've never seen. By the way, I have properties I've never seen with my own physical eyes yet. It sounds like it's about time for me to get a write-off and doing a little trip, doesn't it? Right? Those kind of things you can do. So those all count as hours towards your real estate investing. Now, and people that have Airbnbs, they do this all the time. People that have multiple properties. Now, if you have one property, IRS is going to call bull, right? But if you have multiple properties, even if you're a little bit more passive on some of these, you might be able to actually justify this. Now, here's the warning. If you work 40 hours a week, guess what? You're gonna have to work in real estate more than 40 hours a week average. So if you're gonna select anybody, if you're a married couple, usually we tell people to look at the person that works the least hours or doesn't work at all. Maybe they're a stay-at-home dad or something like that. Cool, well then put it in his name, make him the real estate professional so you get all the write-offs. I have one friend right now, he made over $1 million of actual income, but his actual tax return showed him making $25,000 that year. And that's only because his wife worked as a teacher making $75,000 a year. So they wrote off not just all of his income, but also $50,000 of her income to show only $25,000. Needless to say, he didn't pay any taxes that year because he could show lots of losses based on all the real estate depreciation and other strategies that you can do when you're a real estate professional. Again, talk to a CPA, especially one that knows what they're doing. And this could be something that could be hugely advantageous if you want to create really less taxes for the passive income you're creating in real estate today. All right, beyond just taxes, if you want to know how you can actually invest passively in real estate and what might be the best option, go to our website, moneyripples.com, try the passive income calculator to see how much passive income you could create and actually reach out to one of our people to see what is possible for your situation and what might be the best real estate investments for you right now. Go check that out at moneyripples.com.